is Lance Branch. I'm an LPL financial planner and LPL registered principal. Today, our webinar is preparing your portfolio ahead of the elections. Many people have questions about how to prepare for the outcome of the upcoming U.S. elections and how the market may react. Today, I will go over various scenarios and share with you how to position your investment portfolio based on your risk tolerance and your long-term goals, regardless of the outcome. Please feel free to ask your questions using the Q&A or chat box at the bottom of your screen. I will pause at the end of each slide to give you a chance to ask, and we'll try to answer them as we go. Let me go ahead and bring up the slides. So before we start, again, securities and advisory services are offered through LPL Financial, a registered investment advisor. And my name is Lance Branch, and I'm with LPL Financial. To go ahead and start, we need to understand what sort of happened at the beginning of the year as sort of a recap, history of what's happened so far in 2020. We had rumblings of this new coronavirus coming out of China in January. We realized quite immediately that it wasn't a joke and that it was something to be taken seriously. In February, beginning parts of February, ending parts of January, the markets started to react with the stock market bottoming at some point on March 23rd. And let me go over the agenda first for you, and then we'll go into history of what's happened so far. So we're going to go over the history of what happened so far in 2020, elections expectations, financial advice regardless of the outcome, investment strategies that you can take. Oh, hold one second. Give me 1 second. I didn't have my video on. I apologize. And the fact that we've been in hold 1 second. Let me go back one slide. Okay, so a history of what's happened so far in 2020. We started out with a robust economy, then COVID hit. We had what we would call full employment. Everybody who wanted a job had a job. Then COVID hit. Like I said before, end of January, beginning of February, we realized that it wasn't a joke, and unemployment spiked. The markets essentially tanked. And the markets are going to price in what they think is a bad case scenario. And this was a lot worse than anybody thought. It was a lot worse than the 2008 financial meltdown, and a lot worse than anything pretty much I've gone through in my 22-year career. The Fed increased money supply and support, as many of you know, through PPE and the payroll protection program. And the Fed started buying up assets, which they, by the way, have never done before, and basically supporting the economy and the financial markets. This is very, very, very important, and that I think it helped us stave off what would have been a worse pending disaster if the Fed hadn't stepped in and provided the support that we needed. The market bottomed on March 23rd. That was the bottom. If you had bought in on March 23rd, that would you would have I actually have people who bought in to the market at the bottom, and they are up significant amounts of money. Unemployment bottomed soon after, and we've been in a recovery since then. And as many of you know, the markets have recovered almost all their losses. Aside from the past couple of days, the market's been pulling back. But we've been in a recovery, a pretty decent recovery leading up to the market, leading up to the election. We go to the next one. Okay, the election expectations with what we have coming up on Tuesday. The markets like this. When I say the markets like discord, what I mean is the markets like given the Republicans and the Democrats to argue and sort of come up with a plan. They don't. I know some people think that, oh, the market's going to do better under a Republican administration. The market's going to do better under a Democratic administration. My point to you is the market, and what I'll go through with you, can go up regardless. The market has gone up under Democrat and Republican administrations and Democrat and Republican governments. And the market has actually gone up when taxes have gone up. So the market's like, discord, but let's go through some ways in which they're a lot alike. Both parties are positive on stimulus. Both parties, I think, well, it's not, I think, they are. They want, hold one second, they want another stimulus package, and I expect that to get passed soon. COVID control equals a positive economy. So as we control COVID and as the numbers go down, which happened actually during the summer, the economy, you can expect the unemployment numbers to get better and the stock market numbers to get better. With regard to Biden, he has a history of working across party lines, and he's seen as a little bit stronger on COVID. With regard to Trump, he's an outsider. Booming economy and full employment pre-COVID, and he's seen as tough on China. So with regard to this, you can go through and see, the political party, the Democrats, Republicans in both parties, and how the market, the S&P 500 in this case, did with regard to who controlled Congress and who controlled the presidency, and when both parties controlled the government. Right. All right. So there are, in my opinion, 4 possible scenarios. Please keep in mind, I do not expect, it would be completely unexpected if the Republicans gain the House. So I do not have that as one of my scenarios. Scenario 1 is the Democrats keep the House, they gain the Senate, and they win the presidency. This would be a unified government, and you can see how that's done in the past, about a 9.8% return. That would be the Democrats keep the House, Democrats gain the Senate and win the presidency. The second scenario is the Democrats keep the House, Republicans keep the Senate, and Trump wins. So this would be a split Congress with a Republican president, and you can see how that has done over the past, throughout the years. The third scenario is the Democrats keep the House, Republicans keep the Senate, and Biden wins. And that would be this. And then the fourth scenario is the Democrats keep the House, Democrats gain the Senate, and Trump wins re-election. And then that would be this down here. And what I'm going to do is I'm going to stop, and I was supposed to stop and ask questions that you might have, but let's go ahead and keep this. I'll go ahead and slow down a little bit and answer any questions that you might have. One of the questions that we have is, give me one second. Are there any big moves to make between now and the election? And I'll go over that later in the thing, but what I think you should do is analyze your risk, make sure, know what your risk is, know what your risk tolerance is, and maintain balance in your portfolio. And that's the big thing. I do think, and I'll go through this later on, that cash and the ability to hold cash when you have a scenario where both parties are positive on stimulus and both parties are going to give a stimulus package that's going to be quite large, cash can be a problem and isn't a risk-free investment. Give me 1 second to see if I have any questions. Okay, And so that was the one question that we had, and I'll go ahead and move and continue, and then we'll go ahead and stop again and see if you have any questions. All right. Okay. So election expectations, part 3, both Trump and Biden are pro-stimulus. The Fed is pro-economic growth and supportive. If any of these were to change, I would be negative on the market, but it's not likely. Biden is going to give you a bigger stimulus package, anywhere between $6 to $8 trillion. Trump is going to give you a more measured stimulus package, but still a stimulus package at some point. With regard, and that is in effect, whether he has a Congress that's willing to work with him or not. They came together and did the first stimulus package, and I expect that they're going to do another one, regardless whether Trump gets elected or not. And again, realize there is risk to a heavy cash position because, in the past, the Fed had to print money and actually print and store money. Now they don't even have to do that. They just turn around and add it digitally. And there are videos out there showing the Fed president saying that, they don't have to print money, they just add it digitally. And that's going to, in turn, devalue your dollar, and you have to get your money working at some point. Let's move to, and again, if you have any questions, let's go ahead and stop and ask, answer any questions that you might have with regard to the presentation so far. I do have a question on a contested election. This would be if we don't know a winner on next Tuesday with regard to Trump or Biden, what would happen? And the date, the drop dead date on when we need to know all votes need to be counted is December 6th. I expect that is my worst case scenario. That is the case at which, we sort of need to know, the market does not like uncertainty, and we need to know who is going to be president. We're going to know who's going to control the House of Representatives and who's going to control the Senate, but we need to know who's going to be the president. I do not think we're going to know election night because of the ballots that are going to come in from the mail. In some of these states, they cannot count ballots until this election night. So I do not think that we're going to know unless one person wins in a huge landslide. We're going to have to count all the ballots to find out who wins. And let me just see if I have any questions. Any more questions? Let me see. Again, we had many questions on the contested election, so that is a big thought about what's going on right now. Okay, with regard to giving you advice regardless of outcome, this is some things. This is the main meat and potatoes of my presentation today. This is regardless of who wins or loses next Tuesday. There is going to be instability in the job market, and you need to analyze your financial well-being. You need to, I have a friend of mine who's a financial advisor, and he does a presentation, he did a presentation in the middle of the COVID crisis, and he basically said, look, you need to stop spending money and find out where you're spending money right now and basically cut out anything that is non-essential. So because of the job instability in the job market, you need to find out, what's going on with your finances. The fact is you basically need to find out where you're spending money, and basically get your finances in straight. With regard to your portfolio, know what you own versus what you owe. That would be like a balance sheet for your household. And then I would actually reduce debt. And when it comes to what you own in your 401k, you want to own quality. You don't want to own junk. And by the way, there's a lot of junk investments out there. You know, you basically need that. Junk doesn't typically come back in a market in a market rebound. Junk will typically stay down. Cash positions for non-discretionary expenses, I recommend at 6 to 12 months. Non-discretionary expenses is what you need to live on. That isn't, you know, Taekwondo classes or tennis lessons. It is non-discretionary. It is what you need to live on: your house note, your grocery budget, gas budget, car note, and that's basically it. And what I want you to do is keep 6 to 12 months of that in cash, because the fact is that some people are going to be looking at layoffs, you know, staring layoffs in the face, and that's not a good situation to be in. If we get another market pullback, you get laid off, you want to have money in cash to sort of survive until you get another job. The good news is that we have a job market that is improving, and the job market in certain sectors is still very tight. The other thing is, you want to know your risk. We have a program called Risk Analyze. We own the rights to the program, and it will actually tell you how risk adverse or how risk how you can assume risk in your portfolio and what kind of risk you're taking in your portfolio right now. I will tell you that buy and forget is done. You cannot just buy something and forget it and not think about it or look at it every 10 years. You're going to basically have to buy and monitor, either with a financial advisor, or you're going to have to do the work yourself, and you're going to have to be proactive. There is, I will stress this again, there is a lot of, for lack of better words, garbage out there with regard to investments. I have seen, in my 22-year career, I've seen one situation where where a person bought a stock and had it go to almost zero, bought it all the way down to almost zero, and then had it come back all the way, you know, to today the stock is $280 a share. So typically bad investments, even bad stocks, bad mutual funds don't come back, and you're going to have to be proactive and not buy and forget, but buy and monitor. And let's go ahead and take any questions that you might have with regard to the presentation so far. Okay, give me 1 second. Okay, so we have a situation where a person bought Apple stock a while back. What are the tax implications if I want to sell? The tax implications for Apple, and you can know this, that I had a lot, it's one of my biggest holdings in my branch. You're going to need to look after Tuesday and determine if you want to sell it. I recommend no more than 20% of an individual stock in your portfolio. So with regard to your liquid net worth. So if you have a liquid net worth of, and liquid net worth is what you can sell tomorrow to get cash. If you have a liquid net worth of $100,000 and you have $20,000 in Apple, I do suggest you reduce your position in Apple to below that 20%. And the other thing is, with regard to Apple and some other stocks, the tax implications if the Democrats take control of Congress and the White House after January 1st, we know that capital gains taxes are going to go up. So you could possibly sell the stock and pay a 15% capital gains versus between now and the end of the year versus upwards of 40% capital gains tax after January 1st. So you're really going to want to watch after after the election next Tuesday to determine what to do with Apple. Apple's a great company, but the fact is that I don't recommend you hold too much of a stock as part of your liquid net worth in your portfolio. Let's move on, and give me 1 second. Okay, more investment strategies. I'm getting constant questions about should I get out and get back in, and realize that what I found is time in the market is more important than timing the market. You're going to get out. If you get out, you might be getting out at the top. You're not going to know when to get back in. And possibly if the market falls, you're not going to want to get back in because you're spoofed. So again, what I've found is that people who are in the market for a long time and sort of ride out and keep a balanced portfolio and ride out these small corrections, I think they're better off just staying in the market with a balanced portfolio rather than getting out and going all to cash. You can know this, I will never go all to an all cash position, especially right now. I think cash has some danger, being that the Fed is printing money and increasing money supply. Again, no more than 20% of your liquid net worth in one stock, especially your employer. This is extremely dangerous because what I've seen before is somebody who has over 20% of their liquid net worth in one stock and it's their employer and they get laid off. They're putting too many eggs in one basket, and what we've seen in the past is that basket can get damaged, and you're laid off, the stock's down, and you're having to liquidate at a lower price. If you did get out back in February because you didn't have me sort of guiding you, have a plan to get back in over time. Do not, I repeat, do not put money in one lump sum. So you want to put it in over time in a balanced portfolio, which is, you'll constantly hear me say that. So have a plan to get back in over the next year to year and a half. Very important to quarterly rebalance your account, especially with what's going on right now with the volatility in the market. Having quarterly rebalance, a quarterly rebalance portfolio is going to help your performance out. Again, what I said before, buy and forget is done, and it's not. And by the way, I don't think it's coming back. If you're going to be in the market, you want the best funds professionally selected, and that's what we do. We have a program called MWP. It's called Master Wealth Portfolio. We look at the best mutual funds out there, and we professionally select them, quarterly rebalance them, and it's really done well over the past year. I could tell you at the bottom, the most aggressive portfolio that I have in MWP that I use was down 25% at the bottom. From top to bottom, it was down 25%. The income with cash preservation, which is the most conservative portfolio that we use in Master Wealth Portfolio, was down 3%. And again, the last thing I'll tell you as an investment strategy is be proactive, don't be reactive. So the last thing you want to do is let emotions take over, be reactive, and sell everything when everybody's selling. I could tell you over my 22-year career, I've had 2 people do that. They ended up regretting it. They ended up, by the way, selling at the bottom in 2008, and it was not a good move. Being proactive means keeping your portfolio in balance, having the proper amount of cash, because this isn't a good time. So you might be staring down a layoff down the road. So you want to have the proper amount of cash so that your investments can ride out any downturn that we have. Let's go ahead and answer any questions that you might have. So even with the prior slides, I'll go ahead and take any questions. Give me 1 second. Does the market perform better under a Democrat or a Republican? I mean, I looked at a stat yesterday, and it's pretty even when you look at it. I think the Democrats were about 0.2 of a point ahead. So again, the market's going to go up because the economy is going to eventually recover, and the Fed is pumping money into the system. So the market's going to go up regardless of a Democrat or a Republican administration. Give me 1 second. And in closing, just in general, how I feel about the future, I'm very positive about the future. I do not think this is the beginning of the COVID crisis. You had news this morning that Moderna and Pfizer are prepping their vaccines. So we're going to get a vaccine in the next couple of months, and they're going to distribute that vaccine pretty readily. The fact is that as soon as you get COVID under control, whether that's people wearing masks, socially distancing, not gathering in large crowds, if you get the virus under control with either that or a vaccine, people are going to, spend money again, and the economy is going to recover. And we're going to, we have enough liquidity in the system right now so that the market's going to take off. The other thing I will tell you is we're in why I'm positive for the future is we're in a tech upcycle. Technology and technology investments were down for a while, and the last upcycle we had was when I started back in 1998 and 1999. And of course, you had a tech bubble and a tech crash, but out of that came, the iPhone, which has changed a lot of things for the better. But we're in a tech upcycles happen every 20 years, and we're in the beginning stages of a tech upcycle. I wouldn't say beginning stages, but almost toward the middle of a tech upcycle. Tech, in my opinion, and everybody's opinion, is going to make our lives better. There is some big tech invention that's going to come out, kind of like the iPhone, that is going to make our lives more efficient and more and better. I could tell you what my feelings are is that it has to do with driverless cars and connectivity between your car and your house. That is the holy grail that people are working on right now, along with the whole electric car upcycle right now is going to be huge. You have a situation right now where a electric car motor essentially costs less than a petrol motor or gas engine. So we saw the price of that come down, and it continued to come down. And I read a report last week that now it is less than a gasoline engine. So again, you're going to have situation as tech improves, as technology improves, with regard to electric cars, the amount of time it is to charge and the length of a battery is going to increase. And that's something to look forward to. That's going to make our lives more efficient and better. And the other thing is, I'm getting a lot of questions with regard to the national debt. The national debt, in my opinion, and this is only my opinion, is not something to worry about because you have a growing economy. And I use the example with clients. You have a situation where Apple went from $100 billion to $2 trillion. So if you have a bunch of $2 trillion companies in your economy, and you have, right now you have, I can tell you, Tesla, Amazon, Apple, Facebook, these are all companies that are growing at a rapid pace. That's going to be, as long as the economy is growing and going up, that's going to be, the national debt can basically be in check. So that's all we have to talk about today. I hope this helped you. What I will tell you is analyze what you have. In closing, again, analyze what you have, know your risk level, keep your balance, keep your balanced portfolio. And then if you don't have it right now, I would like you to get anywhere between 6 and 12 months of cash so that you have enough cash to if you get laid off, you have enough cash to basically withhold a market downturn and until you get another job. And I'll go ahead and take any questions at the end, any questions that you might have. Let me just see if we have any other questions. Do you think low interest rates will continue, or should we be preparing for rising rates? There is no way. I don't think rising rates are going to be in vogue for the next 3 to 5 years. Three years at the earliest. But I think we're going to have 0% interest rates for a while. One thing before I go any further, if you haven't refied your mortgage, I would do so, because that is significant savings to your bottom line. And the other thing is, if you haven't bought a house, real estate, that is properly valued, isn't a bad investment right now, because you can borrow money at 2.75% on a 30-year mortgage. And I've actually seen rates a little bit lower than that. So let me see if I have any other questions. Let me see. And that is going to conclude our webinar today. I will tell you this: I will do a webinar sometime in the future, between now and the end of the year, depending on who wins and how the government is going to look next year. There are moves that you're going to need to make between now and the end of the year. But I want to wait. It's going to be basically a post-election type of webinar. And thank you for coming today. And any questions that you have, you can direct them to my email, which is lancejbranch@hotmail.com, or you can text me or call me at 504-957-3532. Thank you so much.